Good afternoon, everybody. Just a quick confirmation, please. Wow, lots of messages coming through the chat panel. Can I just get any one person to confirm that they can see me, hear me, and see the presentation? So 3 yeses, please, if you can indeed. Brilliant, lots of yeses coming through. Well, firstly, yeah, brilliant. Thank you very much indeed. Good afternoon. Thank you for joining. I hope you're all keeping well. You've had an excellent Eid break. I know I have. I have to be honest with you. I decided to do absolutely no work in the last 1 week. That wasn't an easy thing to do, but I did thoroughly enjoy it. And I must say, I hope you've all managed to survive the inclement weather that hit us like a huge storm yesterday, you and your loved ones, of course. It's been a unbelievable experience. I have to be honest with you. I generally thought that we've moved continents. Um, I've only been in the UAE for 2 years, and I don't think I've ever seen anything like it. And I've met people who've lived here all their lives, and they've said they've never seen anything quite like it. So it was an unusual, strange, and at some points during yesterday, a fairly frightening experience. But I'm hoping you're all keeping well. And thank you for being here. I'll start off with a quick introduction. Oh, by the way, if anyone's got any question at any point, use the chat panel like you all have and type away. What I will try and do is leave a little bit of time at the end of our session to try and answer any of the questions. So I don't wish to take any more of your time. I'm going to try and dive in to the key topic today, which is in relation to tax groups. And this is tax groups from a corporate income tax perspective. As you all know, the grouping rules for VAT are rather different. I've just heard from Najwa that there are connection issues. Does anyone else have connection issues? Najwa, if there's nobody else with connection issues, you might have to log off and log back in. Thank you, Imi, for that confirmation. And Imi, always good to hear from you. Thank you, Z. That'll do. I think everyone's all right. So, right, let's do this. Thank you, Najwa. All right, good. Right, there we go. Yeah, there we are. So, by the way, that's me. Just in case you have any doubts, it's me again. I'm slightly more clean-shaven today than I was on that particular picture taken day. I'll give you a little background. Firstly, I'm not a tax advisor. I know that might sound a little bit strange. I've been working in tax since 1998, but I've been working in the dark side of taxation, which is non-advisory. I'm in the educational space, ladies and gentlemen. So I've been teaching international taxation, specifically UK tax, for over 25 years. I moved to the UAE 2 years ago. I said that before. And I am the head of tax at Kaplan, the company that I work for, and I have done so for the last 25 years. And over that 25 years, I've trained a lot of students on passing the tax papers within a plethora of tax qualifications. ACCA, you might have heard of that. SEMA, I know SEMA sounds like a girl's name, but it's actually a professional qualification. And when I taught SEMA many years ago, ladies and gentlemen, SEMA had a massive tax paper in it. Now there is less taxation in management accountancy. There's more taxation in certified and chartered accountancy. I've also taught the ICAEW. I've taught some modules of the Chartered Tax Advisory qualification. Yeah, so I've been involved in tax for many years. And I'm also recently, I know some of you are products of the program, we've recently launched a CIT UAE diploma, CIT standing for Corporate Income Tax, UAE diploma as well, which I know quite a lot of you have partaked in. So thank you for logging back in. That's my background. By the way, we've had a lot of interest from a lot of people for this webinar. I think we had over 400 registrants. All of you will receive a copy of this recording, as far as I'm aware. And we have, and the number keeps growing, we have 66 participants that have joined live, which is excellent, excellent. And like I said, if you have any questions, please do use the chat panel. Yeah, and you know, we've been, like I said, I also managed part of the Kaplan business for over 10 years. So I've been involved in the teaching and management space for many years. But like I said, we're not tax advisors. So who do I work for? Well, before I get to that, guys, I wanted to just quickly introduce you to the key sources. So like I said, I work for Kaplan. Kaplan is I think if it's not the largest, it's probably the second largest global educational provider in the world. You know, it's massive. It's originally from the United States of America. I represented them in the UK for 20 odd years, and I now work for Kaplan in the Middle East. So, you know, Kaplan and I, you know, we are joined by the hip, and I say we've been together for a quarter of a century. Wow. Anyways, now, guys, I think it's important. If you're a tax advisor, or if you need to know about corporate income tax in general, I'll tell you where I get all of my sources from. You know, I also, I'm a vivacious reader. I read a lot. I read articles on newspapers, whether that be the FT, Khaleej Times, Dawn. I mean, there's so many of them. I am an advocate of Twitter. I have a lot of followers and followings on Twitter, and I love the resource. I mean, Twitter has a lot of very clever people who are excellent in sharing their thoughts and ideas, whether it's macro, whether it's tax. So I use that a lot. But purely from a UAE corporate income tax point of view, these are my sources. So number one, you won't be surprised to hear this. Have a look at the decree law. You all know the decree law was released, what is now nearly a couple of years ago, you know, 2022. The tax guides, you'll find the tax guides in the tax.gov.ae website. There's some lots of lovely tax guides. Just remember, tax guides are not legally binding. The decree law is legally binding. The tax guides are literally just that. They are guides, they are interpretations of the decree law, which I find very useful. And I've used it in our presentation today, because as you all know, there was a tax group guide released just a couple of months ago. So, you know, I'll be using that. Tax guides are very useful. So this is the link that you can use, and you get access to all of the tax guides. In addition to the tax guides and the decree law, there are cabinet and ministerial decisions, which are also legally binding. And you can find all of the cabinet and ministerial decisions on the MOF, the Ministry of Finance website. And there it is. I've got all the links for you. And I also dive into the FAQs, the frequently asked questions. Again, that section is found on the MOF website. A lot of this is on the MOF website. The decree law is, the cabinet and ministerial decisions are, and the frequently asked questions. So I would say, if any of you are looking to get information about corporate income tax in the UAE, and you want official information, these are official sources, then I'd say these are your go-to points where you get a lot of information, a lot. All right. So, what's the topic for today? By the way, I'll just say this: if you liked what we do today, and quite a few of you are raising your hands, I assume you're pressing that button by mistake or accidentally. You don't need to raise your hands. If you have any questions, just fire away in the chat panel. All right, I just wanna say that. Right, let's get cracking. Wow, the participant list is now up to 81. This is great. 82 as we speak. So welcome everybody. Welcome. Anyways, I hope you find this pretty useful. A few areas where you can find all the information for corporate income tax. These are all official information, official guides, the decree law, the ministerials and cabinet decisions, and the FAQs. These are all official. All right, now, sorry about that. There's a lot written. I'm going to start off with the tax group. Now, where are all the information? The information that you will see on the following slides, and some of these slides are pretty heavy, so you do have to bear with me. Article 40 of the decree law has information on tax groups, but don't forget, the decree law was very high level information, everybody, very high level. You couldn't really deduce much except for the fact that in the UAE, for corporate income tax purposes, companies can form a tax group. That's the kind of information we got from the decree law. Subsequently, further information was released in the ministerial decision number 125, which relates to the tax groups, which again became legally binding virtually immediately post its release. And I'd say more recently, last maybe 6 weeks ago to a couple of months ago, as you all know, we were provided with a very helpful tax group guide. So first question, everybody. Now, this is quite important. As you all know, maybe a week ago or a few days ago, we also got released the qualifying group guide. I'll do a separate webinar for qualifying groups. My focus today is tax groups. Who can join? What are the implications, tax implications of being in a tax group? And what happens if joiners have losses before they join the group? What happens when a joiner leaves the group? What happens if the conditions are not met? All of that stuff I want to try and discuss. I don't want to spend too long, maybe half an hour of your time. So here we go. Guys, right, this is the information that I got, particularly from the tax guide. So firstly, everybody, only resident juridical persons can be members of a tax group. You've got to be UAE resident and you've got to be a juridical person, i.e. effectively an incorporated business. If your business is run through an incorporation, and there are different types of incorporations, as you all know, that can run a business. The most common example of one in the UAE is an LLC, a limited liability company. So important that we realize the parent and the subsidiaries must be resident in the UAE, and they must be legal persons, not natural persons, legal persons, incorporated businesses. Condition number one. Condition number two. The parent company must own at least 95%. Now, ladies and gentlemen, this isn't just 95% of the issued share capital. No, 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 no. This is 95% of the paid up share capital. So not the issued share capital, but the paid up share capital. 95% of the voting rights. Now, I hope you'll appreciate my next simple point. If you own 95% of the shares in the company, that may not entitle you to 95% of the voting rights, because different classes of shares provide different voting rights. These are just general bits of information. In addition to my first point, if I own 95% of the issued share capital, that does not mean I own 95% of the paid up share capital. I hope everyone appreciates the difference there. Once again, different share classes have different valuations. So to be a member of a tax group, you got to be a resident person. You've got to be a juridical person. And you have to own at least 95% of the paid up share capital, not the issued share capital, of the voting rights, of the profits and the net assets, either directly or indirectly. Now, have a look at what I've written here, ladies and gentlemen. Oh, this is vital knowledge. Indirectly through one, oops, beg your pardon. I'll see if I can highlight it here. Sorry, give me a second. I'm looking at the second paragraph here, right? Indirectly through one or more subsidiaries. I'll get to that very important point because I will try and define what a subsidiary is in a minute. Now, so don't forget, I hope everyone's following, right? Easy. So far, so good. UAE resident, juridical person, 95% of the paid up share capital, voting rights, profits, net assets, either directly or indirectly through one or more. And I'm sorry about this. I don't like people who use inverted commas like I just have, but I had to do it. Something called subsidiaries. I'll explain that. Moving on. Neither the parent company nor the subsidiary is an exempt person or a qualifying free zone person. So the parent company or the subsidiary cannot be an exempt person to be a member or a qualifying free zone person. There is one carve out. Does anyone know of the one carve out given in the decree law in relation to an exempt person? One of the exempt persons can be a parent company, and there is a carve out for those exempt persons. Anyone know? You can use the chat panel if you want, just to type away which exempt person can be the parent company of a tax group and still have a tax group implication potentially where the subsidiaries effectively can benefit. Is there anything like that? All right, we'll get to that. Yeah, excellent, Sandeep. Thanks. Yeah, not quite an investment company, but I take your point. Certainly government-controlled entities. They've got government entities, you're quite right. They have a carve-out. We'll get to that later on as well. Qualifying free zone persons, by definition, cannot be members of a tax group. They just can't. Right? Charitable organizations, unfortunately, are out as well. So qualifying public benefit entities are exempt persons, and therefore they cannot be included. Couple of other things. By the way, you need to have the same financial year if you want to be a member of a tax group. And you must have the same accounting standards. I hope everyone can see my screen. So, these are really important conditions. But the key condition is the definition of a subsidiary. I'll get to that in a minute. All right. So everyone following so far? Yes, great, Augustine. A great point. Dividend earners as well potentially do have a carve out. Yeah, we get to that. Good, good. This is good. Now, sorry. Guys, this information that you see on my screen, this information is on, it's in Article 40. All right. This is effectively, I've quoted Article 40. But from the tax group guide, there was a lot more clarity. Can I just give you some other considerations, which I'm hoping you'll all find very useful indeed? And this is the storyline. I have to be honest with you, I wasn't aware from the decree law personally that any of these conditions could have applied. I only found these out once I had a detailed look at the tax guide for tax groups. All right. This wasn't even in the general guide. You know, there's also a general guide on corporate income tax. This information is specifically in the tax group guide, which was released a couple of months ago. So here we go. Ladies and gentlemen, within a group structure, you can have more than one tax group. Did you know that? So within one group structure, so you have a parent company and potentially 20 subsidiaries of the parent company. Some of them are direct, some of them are indirect. Within that one group structure, you can have more than one tax group. So look at the way I've worded this. This is my interpretation of the tax group guide. Ready? Here we go. In the main group, so the main group will have the parent company and all of its direct 95% subsidiaries. So in the main group, the parent company must own at least 95% of each qualifying tax group subsidiary directly or indirectly through one or more qualifying tax group subsidiaries. Now, ladies and gentlemen, this is going to be important. Do you know the definition of a qualifying tax group subsidiary? Can I remind you of the definition? Guys, it's the slide one. I remind you, to be a qualifying tax group subsidiary, you must be, number one, UAE resident. Number two, a juridical person. Number three, you cannot be an exempt person. You cannot be a qualifying free zone person. Number four, you've got to be a subsidiary in which the parent company owns at least 95% of the paid up share capital, voting rights, net assets, and profits. Just please keep that in mind. All of these conditions that you saw on the first slide applies to the parent company. All right. And remember, to be a qualifying tax group subsidiary, that subsidiary's paid up share capital, voting rights, net assets, and profits, at least 95% of that must be owned by the parent company. And a subsidiary cannot be an exempt person, cannot be a qualifying free zone person, must have the same tax period as the other members of the tax group, and must prepare their accounts using the same accounting standards. By the way, the same accounting standard does not mean using the same depreciation rate on their PPEs. That's not what it means. It means using the same standard, but not the same rates of depreciation. They can be different. So if the group is using IFRS, which is the acceptable accounting standard, each subsidiary must prepare their accounts using IFRS. That's the law. That's what it's trying to say. All right. Keep that in mind. So guys, the main group will be the parent company and all of its direct and indirect 95% qualifying tax group subsidiaries. Yeah, get. I'll try and answer that later. Good. Guys, point number 2. Have a look at what I've written as point number 2. Qualifying tax group subsidiaries not in the main group with the parent company can form a subgroup. Now, I have to be honest with you, I did not know that that was the case by looking at the decree law. But this is in the tax group. This is my interpretation. I want you to follow this. So, guys, subsidiaries that are not in the main group with the parent company, they have the potential of forming a tax group and therefore receiving the same benefits. They can form a subgroup, meaning, but it's very important that you realize, meaning a member cannot be in more than one tax group, all right? So you can't have, so basically one parent company cannot be in 2 separate tax groups. One subsidiary, if it's in one tax group, that subsidiary cannot be in another tax group. It just cannot be. But you can have more than one tax group within a group structure. Yeah, so you can have a group of 40 companies. Within a group of 40 companies, you can have more than one tax groups. Wow. Wow. All right. Now, the other important point, in order to be a member of the tax group, everything that I wrote down on slide 1, guys, all of that, those conditions must be met continuously throughout the relevant tax period. Note number 3. If any subsidiary does not meet the conditions on slide number 1 continuously throughout the tax period, that subsidiary leaves the tax group at the beginning of that tax period. There you go. Oh, by the way, I'm also going to give you some examples, all right? I'll give you some examples. But just bear with me. Just bear with me for the moment. I hope everyone's following. Point number 4, all right? So we had 3 very important points. Point number 4. This is quite general. Ladies and gentlemen, I hope you all agree, the parent company bears the administrative burden of the tax group. In many other countries, the burden is not borne by the parent company. In many other countries, you can actually nominate a representative member who takes the burden. But that is not the case with corporate income tax grouping. The parent company takes the burden. And I've got some good news. You can replace a parent company by another parent. Oh, by the way, the other parent could be one of your existing subsidiaries that takes the role of the parent. And the good news is, if that happens, the tax group does not need to be discontinued. The tax group will still continue to exist, even though the parent company has been replaced during that tax period. So there is that one additional point. Parent companies can be replaced without disrupting the tax group. Now, guys, this is important because many companies in the UAE, they might be registered here, or they might have branches that are registered here, but the head office is overseas. So the company is registered overseas, but their branches might be in the UAE. Yeah, Irfan, I'll answer that question as well. Good, good. Just keep typing in these lovely questions. I'll try and get to that. So guys, let me just make point number 5 clear. The UAE government have made it very clear that to be in a tax group, you've got to be a legal person and you've got to be UAE resident. And they've said the following. Look at point number 5. Documents have to be provided to prove tax residence. They will not be required. So no documents to prove tax residence will be required for any juridical person which is incorporated in the UAE, registered in the UAE, and which is effectively managed and controlled from the UAE. All right. So if a company is UAE incorporated, registered in the UAE and managed from the UAE, they don't need to provide any documentation. However, any other juridical person which is UAE resident, what do I mean by that? So, ladies and gentlemen, a company which is incorporated in the UAE, but the centrally managed and controlled from overseas, in order for that company will have to prove to the FTA that they are indeed UAE resident. Or if a company is incorporated overseas, but centrally managed and controlled in the UAE and therefore tax resident in the UAE, based on that basis, they would have to provide the documents to prove that they are indeed not tax resident in the country of incorporation. So it's important that you realize, if any legal person, if a company is resident in the UAE because it is managed and controlled in the UAE, and not because it's incorporated here, it needs to provide the documentation. Yeah, so it's very important. Yeah, good questions. We'll get to that. Guys, there's one other advantage. Should a group have an overseas resident parent company? I'm on note number 6. I know there's a lot to take in, but we're getting there. We're getting there, guys. Note number 6. Should a group have an overseas resident parent company, it is possible for the UAE resident subsidiaries of the parent company to form a tax group, provided they're held by a holding company. So, ladies and gentlemen, foreign parents can still have the ability to form a tax group. The subsidiaries that are UAE resident can form a tax group even though the parent is not UAE resident. What will happen is the parent company will have to then set up, the overseas parent will have to set up a holding company, which in essence will hold the shares of all the subsidiaries effectively. And then the subsidiaries can form a tax group. Obviously, foreign parent cannot partake, but the holding company and the subsidiaries can form a tax group. Now, I was asked this question: what happens if a subsidiary has a different year end to the members of a tax group? Well, look at note number 7. A resident juridical person can make an application to the FTA to change the start and the end date of its tax period, provided the tax period is not extended to more than 18 months following the change or reduced to less than 6 months. So I've got some good news. By the way, this is not automatic. You have to make an application and the application has to be accepted. So a company that wants to join a tax group, if it has a different year end, it needs to make an application to get that year end changed to make it in line with the tax group, because as you all know, it's one of the conditions. How are you doing? I hope it's not too much information so far. Okay. Now, guys, I've got 3 examples. Everybody, I want you to do me a favor, if you can. Using the chat panel, I'm going to ask you the question. Look at example number 1. ABC LLC owns 90% of DEF LLC and 80% of GHI LLC. GHI LLC owns the remaining 10% of DEF LLC. Ladies and gentlemen, my one question. Oh, by the way, when I give you these percentages, I want you to assume that these percentages represents the paid up share capital, the voting rights, the net assets, the profits. I hope everyone's happy with that, right? Guys, I want you to assume that all of the other conditions are being satisfied. What I mean by that is, ladies and gentlemen, none of these companies are exempt persons. None of these companies are qualifying free zone persons. They all have the same year end. They all prepare the accounts using international financial reporting standards. You get my drift. I'll tell you what my question is. Ladies and gentlemen, there are three companies in example number one: ABC, DEF, and GHI. How many of these three companies can form a tax group on the assumption that all of the other conditions are satisfied? So, ladies and gentlemen, you're only looking at the percentage of ownership condition here. Guys, do me a favor. In the chat panel, you can either put 0, you can't have 1. So your options are 0, 2, or 3. You can't have one company in a tax group, obviously. So your options are 0, 2, or 3. Type away in question number 1. 0, 2, or 3. You can never have one company only in a tax group. That doesn't make sense. 18 answers so far. I'm going to dive into the chat group. 19. Keep going. We've got zeros. We've got 2. We've got a lot of zeros. We've got 2s. We've got 3s. Remember, you can't have 1. Lots of zeros. Zeros are winning so far. We've got quite a few 2s as well. We have 1, 1. We have 3s. 2s are catching up. 2s are catching up. Example 1 only. Okay. %% of DEF. Okay, catching you up. A, B, C, 90%, 80%, D, E, F. GHI. Guys, can you just confirm that you can see my screen with my horrible handwriting on it? Just a quick yes that you can see the screen would do. Thank you. That'll do. That'll do. Thank you. Perfect. 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 And I'm just writing out that question, everybody. Right? You're all following. Nice little example. Just trying to get you guys to think about what I've written there. That's all it is. Yeah, there it is. 90%. And then it tells you GHI owns the remaining 10% of DEF. Just bear with me 1 second as I create this here. So GHI owns the remaining 10%. And my question was, how many of these companies can form a tax group? So firstly, guys, I'm making the assumption again. Remember, this is paid up share capital, voting rights, net assets, profits, all of that. All of that. All of the companies are UAE tax resident, no problems. Same year end, none of them are exempt persons. You've got it. None of them are qualifying free zone persons. The conditions are all being satisfied. But that important condition on the share ownership, the paid up share capital ownership. Guys, well, sadly, and I hope you all agree, none of the two companies, DEF and GHI, are subsidiaries. Firstly, do you appreciate that? If I ask you a question, yeah, I think this is the key point. Ladies and gentlemen, let me just remind you of the ruling. Firstly, ladies and gentlemen, can somebody just type this answer for me? What percentage does ABC own in DEF? ABC's ownership in DEF. Let's try and get that out the way. Yeah, directly is 90%. Everybody happy with that so far? Directly, it's 90%. There it is, directly. What's the indirect percentage, everybody? Yeah, guys, it's 80% of 10%, isn't it? So 80% of 10 is 8 plus 8%. Actually, ABC does own at least 95% of DEF. That is true. ABC does not own at least 95% of GHI. I mean, that's obvious. ABC only has a direct relationship in GHI. So, guys, I'm not going to spend much time on it, but this is quite important. And all of you who said zero, that is the correct answer. And here's the reason why. Ladies and gentlemen, you can only take an indirect percentage. You can only take an indirect percentage via a qualifying tax group subsidiary. Can I ask you a question? Is GHI a qualifying tax group subsidiary of ABC? Yes or no? Y or N? Is GHI a qualifying tax group subsidiary of ABC? No is the correct answer. And ladies and gentlemen, because GHI is not a qualifying tax group subsidiary, the indirect percentage is ignored. That 8% that GHI owns in DEF is irrelevant. Why? You can only take an indirect percentage via a qualifying tax group subsidiary. And guys, a qualifying tax group subsidiary is a subsidiary in which the ownership is at least 95%. I hope everyone's happy with that. Is a UAE resident juridical person, is not an exempt person, is not a qualifying free zone person, is not one that prepares its accounts using different accounting standards or has a different year end. And don't forget, it needs to be a qualifying tax group subsidiary throughout that tax year in order for it to qualify. I hope everyone's happy with this. So, ladies and gentlemen, the fact that GHI owns 8% in DEF is irrelevant because GHI is not a qualifying tax group subsidiary. You can't take that percentage. There you go. All right. Just wanted to make sure everybody gets that. Now, quickly, guys, because I've seen the time, I do want to move on, but it's so important. Guys, quick answer. Example 2. Let me bring it back on the screen. All right, let me bring it back on the screen, please. There it is. Quick answer. How many of these companies in example 2 can form a tax group? Guys, again, there are 3 companies here, A LLC, C LLC, and B LLC. There are 3 companies. My question is, how many of these companies can, through an application, form a tax group potentially? right? Got lots of answers coming through. So a lot of people, remember, you can't have, I think what you're trying to say maybe is one company. By the way, none of these companies are overseas. There's no mention of overseas. Yeah. Good. Lots of answers coming through. Can I go through it? So here's the answer. Good. Lots of answers coming through. You see, this is so important. This is basics, but this is so important to be a part of a tax group. So I really need to cover this. This was the whole point of the exercise. This is why I chose this question or this topic as my webinar. Guys, in this question, sorry, let me just share the screen again. Tell me that you can all see that. I've got A, I've got B, and I've got C. Right? That's what we've got. And guys, the order is as follows. A owns 100% of C and 80% of B. C owns 20% of B. All right, so there we go. A owns 100% of C, 80% of B, and it is C that owns 20% of B. Ladies and gentlemen, which companies? So we've got A is the parent. I hope everyone's, ladies and gentlemen, quick answer. Is C a qualifying tax group subsidiary? It is a subsidiary, but is it a qualifying tax group subsidiary? Yeah, perfect. So guys, A is in, C is in. Now, is B in? This is the crucial question. How about B? Well, ladies and gentlemen, A owns only 80% of B directly. Directly, A owns 80% of B. However, ladies and gentlemen, what percentage does A own in B via C, everybody? Anyone? What percentage does A own in B via C? Easy answer. Can I just do this here? A owns 100% of C. C owns 20% of B. Everybody. Therefore, A owns 100% of 20. What is 100% of 20? 20 in B via C. I hope everyone's happy with that. Not 16. Guys, if I ask you what percentage does A own in B via C, don't forget it's C that owns the 20% in B. The answer is 20. A owns 20% of B via C. Why? Because A owns 100% of C. C owns 20. So 100% of 20 is 20, by the way. Indirectly, A owns exactly the same amount in B as C does. I hope everyone's happy with that, right? You can't do 80 times 20. That doesn't make sense because the indirect is via C. Guys, so in actual fact, ladies and gentlemen, A owns at least 95% in B. So it's 80% directly and 20% indirectly. A owns 100% in B, 80% directly and 100 times 20, which is 20 via C. I hope everyone's following. Now, ladies and gentlemen, I believe B will become a qualifying tax group subsidiary. And the reason why I've taken the indirect percentage, this is very important. You can only take the indirect percentage via a qualifying tax group subsidiary. C is a qualifying tax group subsidiary. All three companies can be included in a tax group. In the previous question, guys, in the previous question, none of them could be included. Why? Because none of them were direct 95% subsidiaries, and none of them were qualifying tax group subsidiaries. Because none of them were qualifying tax group subsidiaries, you could not take an indirect percentage. Is everybody happy with that? Is everyone happy with the fact that in example 1, 0, none of them can qualify? And in example number 2, all 3 can qualify in a tax group, because the 95% rule is satisfied either directly or indirectly via a qualifying tax group subsidiary. Yeah, these are really, this all of this information is in the tax group guide, guys. None of this information is in the decree law. None of this information is in the it's even in the general guide. It's in the tax group guide. Very useful guide, very useful. Anyways, let's go back. We're nearly there. Guys, I'm going to make sure you're all happy with those implications. Last one. Yeah, Gabe, that's a good question. Just to make this clear, Gabe has asked a very good question. Guys, I'm only going to say all 3 companies can qualify to be members of a tax group. All 3 can qualify. You don't have to include all of them if you don't want to. But if you want to include them, they have to make an application with the parent. So you don't have to include all of them. There's no such law that all qualifying tax group subsidiaries of the parent company must be included. So you can leave one out, but as long as the percentage is via a qualifying tax group subsidiary, then you're all right. So I would say, probably, just to answer this, a really good question you've asked me, I don't think A can form a group with B without C, because A is only in the group, sorry, B is only in the group with A as a result of C. So I don't think the FTA would approve that application. Just to answer that bit. Point number 3. Guys, last one. A LLC owns 95% of B. B owns 95% of C. C owns 95% of D. What do you reckon? A, B, C, D. 95, 95, 95. That's the question, guys. That's the question. I'm hoping you can all see that on my screen again. So, guys, let's talk about it. Do you all agree? A and B, yes. Do you all agree? A and B, yes. Do you all agree with me? A and C, no. A and C, no. So A and B, yes. A and C, no. So just to make this point, A, B, and C cannot be in one group. Why? I hope you all agree. A does not indirectly own at least 95% in C. It owns 95% of B. B is a qualifying tax group subsidiary, and B owns 95% of C. But A does not own 95% of C. So A and B, yes. A, B, and C, no. A, B, C, and D, no. Now, guys, I have a question for you. Everyone happy with this? So, main group, everyone, main group. Number 1 is A and B. Let's say. Guys, question. Can B and C form a subgroup? Yes or no? Just Y or N. Can B and C form a subgroup? Ladies and gentlemen, here's the answer. Are you ready? This is important. The answer is no. I'll tell you why. Guys, a subsidiary or the parent can never, ever, ever be in two groups. They can only be in one group. So, guys, let me make this clear. If A and B are in a group, B and C cannot be in a tax group because you can't use B twice. B cannot be in the main group and in the subgroup. Is everybody happy with that? If you want B and C to be in a group, A and B cannot be in a group. So guys, B and C, no chance. B and C, no chance. If A and B are in a group, B and C cannot be in a group. You cannot have one company in two groups. You cannot. That's what the tax group says. Cannot. Cannot. Now, guys, last question. How about C and D? Yeah. So I tell you, guys, these are four companies in one group. How many of these four companies can form a tax group? The answer is A and B can form a tax group. Yes, for sure. Unfortunately, C and D cannot be included with A and B. You know why? B and C cannot form a separate tax group because B cannot be used twice. But the second group, the second group is C and D. C and D can form a tax group, even though C is not the parent company of the group. It is deemed to be the parent company of the second group. Yeah, so C is the de facto parent of D. From a tax group perspective, this is according to the tax group guide and my own interpretation. I hope everyone's happy with this. Guys, from this question, if I asked you how many of these companies can form a tax group, the answer is, well, there are two tax groups. And in each tax group, you can only have two companies, A, B, C, D. How are you doing? Yeah. Everybody, let me make this clear. Absolutely. If you have B and C, guys, it's your choice. You could decide for B and C. If you have B and C, guys, what groups cannot exist? If you go for B and C, which is possible, according to the tax group guide, is possible. Guys, can A and B be in a group if you have B and C? Nope. Can C and D be in a group if you have B and C? Nope. You got it. So don't forget, you can't repeat a company. You got it. You cannot repeat the company, and therefore it's up to you. But I want you to all appreciate these are some very important, subtle bits of information in the tax group guide. So I wanted to discuss that implication in this webinar. I want to go back. Right, let's move on, guys. I'm conscious of the time. Maybe 10 more minutes. Right. I just want to make sure I'm back on it. Yeah, I am back on it. 10 more minutes, and then we call it a day. I have a class to do in the evening as well. Abroad, just to answer that question quite quickly, A and D cannot be in a group because A does not control at least 95% of D. Four of them cannot be in a tax group abroad. That's the point that four of them cannot be. For all four to be in one tax group, A must control 95% directly and indirectly in all of them, and they don't. So you can't have it. Let's move on. Guys, next question, next bit. So, by the way, I've asked this implication. What's the good news? The good news is administration. Administratively, the parent company will be the one responsible for filing a single tax return on behalf of all of the members of the tax group. The one disadvantage, as you all know, is if you have 20 companies in one tax group, the other 19 can just chill out. Guys, to be honest with you, they're all consolidated, right? So just so that everybody's happy with this, It's the parent company that's responsible for preparing a consolidated set of accounts. Then from that consolidated set of accounts, the parent company will calculate the taxable income of the tax group. You all know what that means. I know you all know what that means. There are some items of income and expenses in the consolidation that might have to be removed, as you all know, in order to form a tax group, in order to calculate the consolidated taxable income, because not all expenses are allowable, not all income items are taxable. You know that. So the parent company does all of that. There are 19 companies in a tax group, including the parent. The other 18 can just effectively relax. They provide all of the information. The parent company does all the work. So that's one advantage. But there's only one threshold. When the parent company calculates the taxable income of the tax group, they only get 375,000 limit. But you know that already, right? You know that. Now, what's the other advantage of being in a tax group? Guys, the income and losses of the members of the tax group can be offset against each other. Now, can anyone give me one bit of news? Anybody? If one company has a tax loss, does anyone know what that company is allowed to do with a tax loss? Does anyone know? What's the general rule in the UAE in relation to utilizing your tax loss? Anybody in a chat panel can quickly mention it before we move on. Yeah, Ajmal, good. You're nearly there. Guys, a tax loss can only ever be carried forward and offset against the company's future taxable income. And the maximum loss that can ever be carried forward, it's restricted to 75% of the available taxable income in the next year. So I hope you all agree, although it's good news, it isn't good for cash flow. Well, guess what? In a tax group, I've got some good news. If one member of a tax group incurs a massive tax loss, they can offset that tax loss this year on the consolidation. They do not have to carry it forward, wait for 12 months, and offset against their own 75% of the taxable income. No, 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 no. So one company in a tax group has 100 million dirham tax loss, and all the other members of a tax group have 100 million taxable income. Guess what? The taxable income of that tax group on consolidation will be zero. So that's some good news. Losses can be offset now. Yeah, no carry back, guys. You can never carry back a tax loss in the UAE. The good news is you can offset it against the other members' income on consolidation. This is an advantage, of course, of a loss. There's no 75% restriction. Yeah, the 75% restriction does not apply if you're offsetting the loss in the same year. And by the way, you can keep carrying it forward indefinitely. There's no restriction to the number of years of carry forward. That's in the tax legislation in general. Now, next point. Pleasure. Guys, it should say 1, 2, and 3. Also, here's the other big advantage of being in a tax group. If there are any assets or liabilities, or indeed any transfers, so let me make this clear, any transfers of goods, services, assets, liabilities between members of a tax group are simply eliminated on consolidation indefinitely. So, ladies and gentlemen, the other advantage, all transfers whether it's goods, services, assets, or liabilities between qualifying members of a tax group, they are eliminated on consolidation, irrespective of how much money was actually exchanged on the transactions. Although I want to make this one point very clear. Yeah, if they generate a profit, they have to be removed. If they generate a loss, they have to be removed. Yeah, absolutely. Even if they generate a profit or a loss, this is another advantage. All intergroup transactions are eliminated. But ladies and gentlemen, let me make this absolutely clear. These transactions must, however, happen at what value? Anybody? What is the value that these transactions must effectively still take place at, even though they're eliminated? Important. Yeah, at arm's length, I think that's a very important point. Thank you for making that clear. Guys, the transfer pricing rules. So let me make this point clear. The transaction does not need to be reported in your master file or local file because it's eliminated. But what you still do need to keep a copy of is you have to be able to ensure that these transactions are still at arm's length. They have to be at arm's length. We'll talk about when you still have to apply them. Yeah, arm's length. They're effectively taken at book value, but the actual transaction needs to be at arm's length. So it's important that we keep that in mind. Guys, this is going to be my second last point. And I'm going to make this clear. This is very important. I want you all to realize this. Ladies and gentlemen, I've said one thing to you all. One of the main advantages of a tax group is consolidation. It's a disadvantage for the parent company because they have to do all the work, all the hard work. But the other subsidiaries can get on with doing what they do, running their successful businesses, and stop worrying about filing and calculating taxable income, consolidating their returns. All of that can be done by the parent. So this is a big advantage. Subsidiaries can get on with doing what they do best, day-to-day activities. They don't have to worry about tax too much unless they leave the group. Yeah, they have a big transfer pricing rule, Augustine. That's a separate course for that. Now, guys, let me make this clear. The following companies in a tax group must prepare their own standalone statements and taxable income. So let me make that clear. The UAE government has made it clear that although consolidation happens, the following types of tax group companies must calculate their taxable income separately, and therefore they must abide by the transfer pricing policies and documentation. And here they are. Guys, any tax group which has unutilized pre-grouping tax losses, it's the first bullet point. So if you join a tax group and you had tax losses from before, you cannot combine your taxable income. Your taxable income has to be calculated separately. It has to, before consolidation. Good question, Irfan. I've been informed, just to make this point clear, I've been informed that the auditing can happen on the consolidation level. It does not need to happen on the individual subsidiary, tax group subsidiary level. That's the information that I've gotten. So auditing only at the consolidation level. The taxable income needs to be calculated separately, but the auditing can be done at the consolidation level. Now, secondly, guys, any member of your tax group, so any tax group company which wants to claim a foreign tax credit must have its own standalone taxable income calculation before consolidation. So these companies have to have a standalone calculation. Any company which has losses from before any company wanting to claim a foreign tax credit, and any company which, ladies and gentlemen, has any pre-grouping net interest expenditure. You know these safe harbor rules. You must have all heard of them. 30% of EBITDA is the maximum amount that can be offset. Any remaining is carried forward. So if you join a tax group and you've got these important unutilized pre-grouping net interest expenditure carried forward, you have to prepare your statements separately. The auditing needs to happen at the group level, but your taxable income needs to be calculated separately. It's very important that you do that. You can't just combine everybody's. These are the three types of tax group companies that must prepare their documentation separately, their taxable income separately, and they must abide by all of the transfer pricing policies and documentations. Not just the arm's length, also needs to be documented. Any transaction between members and these companies, although they are eliminated, guys, they are eliminated. Don't get me wrong. Transactions between group members are eliminated. But any transactions involving members of a tax group and these companies that are in the tax group, it has to be kept separate. Policies and procedures must be written. All right, good. How are you doing, guys? And oh, by the way, I'd like to again make one last point clear, and it's in relation to the treatment of my losses. Guys, and the treatment of losses is as follows. If a tax group makes a loss, so just so that everyone's happy, if a tax group makes a loss, I've made it clear, if any company within the tax group makes a loss, it's offset against the taxable income of the other members in full, no restriction. The restriction only applies if losses are being carried forward from the past. Guys, any losses being carried forward from the past, just please be aware, they are the ones that have the restriction of the 75%. So a tax group from the past, how much of that loss, a tax loss from the past can be offset this year up to a maximum of 75% of the taxable income of the combined tax group. But current year tax losses can be offset in full against the current year taxable income of the remaining members of the, it's just done on consolidation. So there's no problem here, right, guys? So that's an important point that I like. Treatment of losses. Current year losses are offset in full. How can other country company can take tax credit if it's not audited in the UAE? So again, I'd like to make this point clear. The consolidated accounts need to be audited. So the consolidated accounts will have the accounting information of all of the representative members, even those members that are claiming a tax credit or not. So every member of a tax group will have their accounts audited on consolidation. The only important point is the taxable income of these specific members need to be calculated separately because the foreign tax credit can only be claimed against that taxable member's income, as it were. So it has to be done separately. You're right. They don't need to have had their accounts audited individually. The auditing happens for the entire group, but the other implication is important. Yeah, you're right. It can be used in N+2. Absolutely agreed. Now, last question. I just want to just make sure. By the way, there's a strict order in which the losses are utilized, guys. Strict order, and there they are. Just so that everybody's aware. If losses are being brought forward from the past, everybody, if you're bringing forward losses from the past, please note there's an order in which the losses are offset. Pre-grouping tax losses must be used up first. then any post-grouping restricted tax losses, followed by post-grouping tax losses of the tax group, followed by any qualifying group losses. Now, I'm not going to get into too much detail, but I want you to please be aware, pre-grouping tax losses must be used up first. So any company that joins the group with a loss from before, those losses have to be utilized. And don't forget, if you're bringing your losses forward, you can only use up to 75% of the taxable income of the tax group. That's if you're bringing it forward. If your loss is incurred in the year that you are part of the tax group, that's offset in full on consolidation. Anyways, I'll leave it right there. I hope everyone's happy. I've got some examples. Guys, do me a favor. You'll find me on LinkedIn. I've talked about foreign tax credit as well. You will find me on LinkedIn as well if you need it. Guys, get in touch. What I'll try and do is I will make sure this presentation is shared with each and every one of you. Thank you for registering. Guys, just to give you a quick idea, we also have a corporate tax diploma that we run in the UAE. And if you're interested, somebody or the other might get in touch with you. I'm not selling it on this particular webinar. This webinar was for understanding the implications. I know there are quite a few questions that I may not have answered, and I've run on a lot. So I'll try and pick that up later, if that's okay with you guys. Guys, get in touch with me. Please get in touch with me via LinkedIn. If you want to find me, my name is Ammar Mera. I'll send you this presentation. Somebody from my team will be in touch with you all. I hope you found it useful, guys. Thank you for your time. There'll be more of these webinars later on, much more. So look out for it. Guys, thank you for your time and thank you for joining. Thank you so much. I hope you all found it useful. I hope you did. Oh, you guys have written some lovely messages. Thank you very much indeed, ladies and gentlemen. Much appreciated. Thank you, thank you, thank you. All the best. Have a pleasant evening. Have a super week. And look forward to my next webinars. There'll be lots more coming up soon. Thank you. A lot of names I recognize from my diplomas. Thank you, Nandini. Nandini's also posted information. It's on the slide as well. So do get in touch if you need anything. You guys have all been absolutely brilliant. Yeah, Sheila, we will share the diploma details for sure. It'll be shared on the email that we'll send all of you very shortly. Thank you so much for your time. I hope you found it useful. This is how we do this on our courses. We dive into all the key points. Thank you, guys. I can't even take the names because there's so many of them going through and through and through and through. But you guys have been absolutely fabulous. Thank you so much, ladies and gentlemen. I'm going to log out. Take care. All the best. Get in touch. We'll be in touch with you soon. Thank you. Cheers, everybody. You've been brilliant.